Thank you, Matthias. It seems you stole my speech, because virtually I agree with everything you said. Okay, well, let's try to make it fun then. So thank you. Thank you for having this conference. It comes very timely in terms of the European agenda, and I'd like to thank also Pierre Wunsch and the National Banks of Belgium for hosting us today. As you know, the new Commission has not yet taken office, so it's a bit difficult to say what it's going to do, except that in my case, I'm privileged because my new boss is my old boss as well. So maybe I have a better idea than I would otherwise have about what he is intending to do. I'd like to start by maybe speaking, as you did, about the Capital Markets Union more generally, and then turn to the Commission's post-trade agenda as I see it. At this stage, probably more questions than answers. And finally, I will have teased you enough, so I'll conclude with a few words on CSDR, because that's probably what you're mainly interested in. So the Capital Markets Union, well, as you know, the Capital Markets Union at the end of the Juncker Commission is a story of half empty, half full glass. Well, the glass is half full because all the issues that we had identified in the two consultations that we have run, very wide consultations, and I have to say that every idea we thought was worth pursuing, we have pursued. That led to 13 legislation being proposed by the Commission, 11 are adopted, and the remaining 13 are well on their way. So that's the half-full part of it. The half-empty is that, of course, two things. One, Capital Markets Union has always been a complex, multidimensional, long-term project. There are many, many reasons why market interactions in many places do not happen. So you first need to understand why, and then you need to restore the incentives. And that's a very long process. It's not like capital market, it's not like banking union. Banking union is a cathedral. It's complicated politically, but it's easy in design. Well, Capital Markets Union is both complicated politically and uneasy in design. And even if you manage to do this, once you have change the settings in order to try to restore the incentives, and assuming you got it right, then you need the market to understand that, and you need some time for the market to start to colonize the structure and make it happen. So we never thought Capital Markets Union would be functional by the end of the previous mandates. Our mandate was to put in place the building blocks. We think this is what we did. We need to move now to phase two. And phase two is about maybe trying to hit some of the big tickets that we couldn't tap into in the last mandate. And we couldn't do this for an essential reason, in my view, and this reason is the lack of trust. It's actually the same reason that led, I said just a minute ago, that quantitatively we did well in the Juncker mandate. Qualitatively, not quite so. Because for all of these 11 projects that has been adopted and are now EU legislation, the degree of ambition of the final product is far lesser than the original one, to the extent in some cases that one can have doubts whether the plane can fly. So we shall see. So we need to have a conversation with the member states about what is exactly the degree of commitments to the Capital Markets Union project. Because the macroeconomic narrative is well known. Capital Markets Union is the only way to significantly increase the funding of the economy. So that you have a quantitative impact, and if we want to higher our potential growth, we have to make it. Capital Markets Union is the only way to provide, in particular, innovative companies that will be defining of our competitiveness of tomorrow with a more adapted financing mix than the one they get. Of course, any company needs a bank, and preferably a solid and well-performing bank. But all the tech, fintech, biotech, gentech, whatever tech, they need capital. And that's not the job of a bank to provide you with capital, or not necessarily the job of a bank. Or at least few banks are doing it properly. So we need to develop an ecosystem that allows these companies to get access to the financing mix they need at the various stages of their evolution. So you have a qualitative aspect. And if we cannot manage this, we'll have huge difficulties in managing the digital transition that is ahead of us. We'll be lagging behind. We're actually already lagging behind. Thirdly, we have a formidable challenge, and that is really a revolution, which is to manage the transition to a low-carbon economy in 30 years. If we want that the planet remains livable for our children and grandchildren, we need to be carbon neutral by 2050. It's one thing to say it, it's another thing to understand what it means. It means a complete revolution of the way we live, produce, sell, buy, transport, etc. The analogy that I would take is the analogy to a war economy. It's not my analogy, actually. It's an analogy I borrowed to John Kerry. John Kerry says, well, the transition to being carbon neutral in 2050 is like D-Day. So you're a year ahead of D-Day, and you know that you will have to produce rifles, you will have to produce boats, you will have to train people, you will have to assemble logistic chains, you will have to have all this coordinated at the same time with also the planes, and et cetera, et cetera. All this to be on D-Day on that beach. Well, that's exactly the challenge we have, all this to be carbon neutral in 2050. So that will need considerable efforts, and I don't think public and private decision-making powers have fully taken and grasped the scale of the challenge. But certainly, one thing is for sure is that for this, we will need to be able to invest in this process of transformation 200 to 300 billion of additional investment in Europe per year. And for this, we will need a functioning capital market union. If we fail in the capital market union project, we cannot succeed on the low-carbon transition. That's as simple as that, and that's why it is important. So we need to have this conversation with the member states. Of course, for as much as they don't trust each other, there is only one thing they trust less than each other, and that's us. So we're not the best place to have this conversation. That's the reason why Mr. Dombrovskis has just launched what we call the high-level forum, and we have decided to ask Thomas Wiese to chair it, because Thomas has several specificities that make him particularly fit for purpose. He's been the chair of the EFC for more than a decade during the crisis. He has the trust of all the member states' finance ministers as such, and he has the trust of the Commission. And finally, he is a man of few words, but he says bluntly what he has to say. And it is time that we ask the member states, are you serious with this project? What is it exactly you are ready to compromise on your national legislation in order to make it happen? Let's take an example, insolvency laws. All the member states tell us insolvency law is very important to have an harmonization. What they mean is, I would love that there is an EU insolvency law that is modeled exactly on my national one. Because they're not prepared to concede usually on any other option. Let's take an example. We have proposed more than 2 years ago 2 very small projects, because we knew going for a full harmonization of insolvency law was not possible. Second chance for companies that have a good economic case but are in financial difficulties. So therefore, the best way to safeguard value is actually to give them a second chance, restructure, because their economic case is fundamentally good, and accelerated access to collateral for the companies for which the economic case is not good, and therefore they should exit the market as quickly as possible, and the bank should be able to access the collateral quickly. These 2 small things are blocked. So before we talk about a huge project of harmonizing insolvency law. Let's discuss what we're really ready to do for it to happen. And this goes for many, many, many topics. And this is the very daring task that is ahead of Thomas, as well as actually identifying any promising project that has not been yet identified or pursued. Because Capital Market Union is this strange mix of very big tickets and small things, but that make a difference in the market. And it's also your job. I mean, it's not the Capital Market Union of the Commission. It's actually your Capital Market Union. So there is a bit of industrial engineering to be done, and I don't think it should necessarily be done by people like me. It should be done by people like you. Let me take an example here as well. One of the great pities of Brexit is that we're losing the City of London as a very big financial center that had understood that their interest in Capital Market Union was leveraging on new technologies, helping building small capital markets in small jurisdictions, which were completely uneconomical 20 years ago, but can be done now with fintechs, distributed ledgers, etc. Because, of course, that's a hub-and-spoke system in which everybody is beneficial. You link these small markets to your very big liquidity pool, they benefit, and you benefit because you attract new business as well. It would be difficult to continue building this with the city in the new setting post-Brexit. How is it that Frankfurt, Amsterdam, Paris, others are not more active in trying to seize these opportunities? I stop here just to mention, of course, and this is what I will focus for the rest of my speech, that post-trade services have also a huge role to play because you're the deep layer of stability of that system. You're the plumbing behind capital markets. So ensuring that post-trade services function efficiently and smoothly is absolutely vital. And we need to have this if we want an integrated and efficient capital market union. So let's have a look at the post-trade agenda. Since the Giovannini reports, let's go back to antiquity. It was only, however, at the beginning of this century. The EU's post-trade landscape has gone through quite some heavy lifting. We have had major EU regulations in response to the crisis. This is where I started to get drawn into the world of finance. So I take full responsibility for EMIR, CSDR, and SFTR, for example. Quite many others, but as far as post-trade is concerned, let's take these ones. These regulations have made post-trade activities and infrastructure safer, stronger, and more transparent. These rules have modified, and they continue today to change, the way post-trade services are provided in the EU. They have contributed to removing major obstacles to an integrated post-trade market, and for instance, national differences in settlement cycles. And more changes are coming with significant implementation efforts. I'd like to start with clearing and a number of recent amendments to EMIR that have probably not escaped your attention. First, in June of this year, amendments to simplify and make the EMIR rules on clearing and reporting more proportionate have become applicable. They will help reduce burden and cost for market participants without putting financial stability at risk. This is what we call EMIR refit. A number of technical acts are necessary now to implement EMIR refit. We have started a consultation that is now ongoing, for instance, on how to ensure that access to clearing is fair, reasonable, and non-discriminatory. The need for policy action in specific areas will also be assessed more closely through a number of reports, including notably on the interplay between trading and clearing obligations. Secondly, in mid-October, the co-legislators have adopted another set of targeted amendments to EMIR to strengthen the supervision of CCPs in the light of their growing systemic importance, what we call EMIR 2.2. EMIR 2.2 is all about risk and how to mitigate risk. Its objective is twofold. Internally, fostering convergence in the supervision of CCPs established in the EU, and externally, improving the supervision of third country CCPs that provide services to EU firms in function of the risks that they represent for the stability of the EU financial system. Preparatory work is ongoing to ensure that the new supervisory framework is effective as soon as possible, and I'm in close and constant contact with Steven Meyer on this subject. We are working to make the new approach proportionate, predictable, and efficient. But clearly what is key there is safeguarding financial stability. We intend to seek public feedback on that approach before the end of this year. Third, negotiations are still ongoing on how to mitigate CCP risk in case of a crisis. What we call Ccp Recovery and Resolution, although it's more recovery than resolution, to be fair. And the objective here is to ensure that both CCPs and national authorities have the means to act decisively in a crisis scenario. By fostering the move towards central clearing, we have, first of all, eliminated quite a lot of the risk that was present in the market, and secondly, we have made it more apparent to supervisors and therefore easy to supervise. At the same time, we have created very, very systemic entities, and we need to take care of this now. Implementation is also going full steam ahead in other areas, for instance, in settlement. So an area very close to you, the settlement discipline regime for CSDs is expected to become applicable only in late 2020. And I will speak more about CSDR in a minute. The reporting obligations under SFTR, the Securities Financing Transaction Regulation, will also start to be phased in 2020. In light of the significant changes that have taken place and that are still in the pipelines for post-trades, the question now is, are there remaining cross-border obstacles to address? Have new challenges emerged, potentially as unintended results of the new rules? The Commission ran a public consultation on post-trade in CMU, and we have published the feedback at the end of last year. What were the main messages? One, that we should focus on the implementation of ongoing initiatives. And two, that any further adaptation of the EU post-trade legislation should be carefully thought through. I'd like to say at this point that it's a general line of thoughts that I have, that is, you cannot expect market participants to redirect their mind towards long-term investment, everything we need in the frame of CMU if you keep on changing the rules all the time. So let's focus on implementation. If there is something that is really broken and doesn't work, let's make a target change, but let's not reinvent the wheel every time there is a review, because that's not so productive, and I think this is part of the issues that are preventing the quick startup of capital markets in Europe. Now, a new commission starts, and it is the perfect moment to take stock and think about what may come next in post-trade in the light of what I just said. We have a dialogue with the industry and other stakeholders. We regularly hear about the potential challenges to tackle, often related to the need to keep up with market developments, but also technological change, and also to ensure competitiveness and level playing field. So a number of questions may need, or not need, to be looked into in more details. Let me take a few of the questions we ask ourselves. First, is there a need to upgrade centerpieces directives that were adopted in the turn of the century, so not the post-crisis regime that I just mentioned, in light of recent regulatory and market developments. What I mean is, are EU rules on collateral that are set out in the Financial Collateral Directive fit for the future? They're quite old. The world has changed considerably since. We ought to ask ourselves this question. Do they cater for the major evolutions in the use of collateral assets over the last 10 years? Thinking of the Settlement Finality Directive, should we consider broadening the scope of participants to designated payment system to non-banks? Does the definition of finality remain adequate in light of the increased importance of certain functions, such as collateral transfers, for instance? Second, how can the Commission better tackle long-standing issues such as corporate action processes and withholding tax? Which stakeholders continue to identify as remaining obstacles to efficient post-trade activities? And third, is the current EU post-trade framework technologically neutral? Does it allow embracing the opportunities that fintech offers? And does it allow to provide for the necessary protection against some of the challenges that it raises? So all these are the questions that we are asking ourselves and that we are likely to consult on. There are, of course, a number of other questions, some of which are far more technical, some of which are far more too technical for me. And we will need to reflect on all of this collectively. There will be opportunities to do so as the new Commission will take place. Now, I've been teasing you enough, so let me say a word about CSDR. That's probably the piece of legislation you're most interested in. And a lot has already been achieved since 2014, when CSDR was adopted. Mr. Barnier was Commissioner for Financial Services. I was his head of cabinet. I have vivid recollections of that period. A number of important processes, such as settlement cycles, have been harmonized across the EU. 14 CSDs have been authorized, and we hope the remaining ones will follow in the very near future. The level 2 measures under CSDR have all been finalized and adopted. But as I mentioned already, not all of CSDR applies yet. Importantly, the regulatory technical standards and settlement discipline will only apply for September 2020 on. And on this point, I would like to underline that I know CSDs and other market participants are working very hard right now to implement the requirements of the settlement discipline regime. And we understand in the Commission the complexity of that task and very much welcome the commitment of CSDs and the effort they undertake. Due to their key position in the settlement process, CSDs and the security settlement systems that they operate are of crucial importance for the functioning of securities market. The key objective of CSDR is to increase the safety and the efficiency of issuing and settling securities. So a successful implementation of CSDR is therefore at the cornerstone of the post-trade strategy in the Capital Markets Union, and CSDs will, I'm sure, benefit from it. Now, I know that there are still open questions on some parts of CSDR, and there are certainly potential areas for improvement. Some of these could potentially be addressed in a review of CSDR. But that being said, as I alluded to already, I think we need to think carefully and consider how to approach a review of CSDR. Let me tell you which are the aspects I think are worth taking into consideration. First, important provisions of CSDR, such as the settlement discipline regime, are not yet applicable. Even the authorization of EU CSDs is not yet complete, although we hope very much it will be shortly. With this in mind, I think it's fair to ask yourself whether now is really the right time to undertake a full and comprehensive review of CSDR. Second, I am very well aware through the conversation we have with stakeholders that there are certain targeted areas which many of you see as a priority for review. For example, how CSDR operates in relation to the cross-border provision of services. For example, the challenges that are faced by CSDs of all sizes in relation to the CSDR requirements for providing banking ancillary services, and in particular cash settlement. So we will need to find the right balance in that review between fixing what needs to be fixed and not trying to unsettle the system by making profound changes. Third, we need to bear in mind that providers of CSD and ancillary services are increasingly exploring new technologies in relation to both traditional and digital assets. Any evaluation of the CSDR, in my view, should aim to identify potential obstacles for the use of such technologies while maintaining technology neutrality in line with the Commission lines in the FinTech Action Plan. It could also identify potential regulatory gaps or deficiencies in the light of the very objectives of CSDR, which is to ensure the safety and efficiency of securities settlement and settlement infrastructures. Finally, our reflections on CSDR should not only take into account regulatory aspects, there have also been significant market-driven efforts. In particular, the development of the Eurosystems settlement platform T2S. Hence, the complementarity between CSDR on the regulatory side and T2S on the operational side is a very important aspect, in my view, of the review of CSDR. A conversation on how to best approach the CSDR review, as you see through these few examples, therefore needs to take place. We need to calibrate the degree of ambition. We need to address the issues that need to be addressed, some of them urgently. At the same time, we need not to revolution the system that broadly, in my view, is the right system and works. After the new Commission has taken office, we will shortly engage into the discussion about how best to approach the evaluation of CSDR and to which extent a sequencing or a phasing approach should be envisaged. A market consultation will obviously be part of that process, but the Commission does not intend to act on its own. ESMA plays a very important role in the CSDR review process. The reports that ESMA is planning to prepare under Article 74 of CSDR will be a very essential element to feed into the analysis of the Commission and the approach to the review. At this stage, it is difficult to make any more definitive statements on what is the way forward going to look like. This is also not something that public authorities will do alone. And here, ECSDA and its members are key interlocutors for us in this process, and we will make everything to try to move forward together in any assessment of the issue. So we look forward to engaging with you in this process, and on this note, I wish you a very productive conference today and a very good day. Thank you.